Hey everyone, welcome back. I wanted to spend a little bit of time today going over some more misconceptions about money and financial terms. One of the goals of this video and even this channel is just to try to address concepts and ideas that people think they understand or you might think you understand when in reality it might be a little more complicated than you actually believe, or you might have it completely misunderstood from the jump. I have spoken about some of these concepts in some other videos, but wanted to just expand a little bit more on some of them here in this one. So with that, we'll get right into it. Number one is compound interest. This is a term that speaks to this idea that when you invest money and it earns money, the money that you earn makes money on itself, and that continues in an exponential fashion so you can grow your wealth at even a more rapid pace the more you accumulate. I wanted to spend a little bit more time illustrating this, so I took two examples here and I want to talk through them with you. So if you take a look at this visual here, and by the way, this was just pulled from an investment calculator, very easy to Google. Notice that I started with $0 in the account and I assumed an 8%, which is pretty conservative, rate of return over the course of 20 years. And that 8% is compounded annually. And let's say that we're putting in $1,000 per month, so $12,000 a year, into this account. Now, quick caveat on that, I understand that $1,000 a month is a lot. It's a very significant amount for a lot of people. I very much encourage you to go into an investment calculator and plug in some numbers that might be more appropriate for your situation. And I think you'll see the power of compounding. Check out the results to the right. Notice that in this scenario, a total of $240,000 was contributed. But after 20 years, way more than that amount, almost $329,000, was interest. So the total is significantly more than double what you actually put in. That's an illustration of the power of compounding. Let's have a little fun and let's add 10 years to the same scenario. So if you take a look here, again, everything else is the same. Nothing is in the account to start. Still a 8% rate of return compounded annually, $1,000 per month. By the way, I know these visuals don't show the $1,000 being per month. I cut that off when I took the picture here, but it is a $1,000 monthly contribution. Notice that after 30 years, we have a total contribution amount of $360,000 and over $1 million of the total ending balance came in the form of interest. So almost 3 times the amount of contributions came in the form of interest and growth. None of it was the money that you put in. It just illustrates in a very clear and powerful way how significant compounding can be. This also kind of gets to the idea that the earlier you start, the more powerful your dollars will be over time. So again, if you're young, please take advantage of time. It is one of the greatest tools in a wealth building journey, and compound interest is a great way to really illustrate that point. Moving into number 2, APR versus interest rate. So your interest rate is what you think you're paying. APR is what you're actually paying because there's additional fees in there. I don't want to spend a ton of time on this. Anytime you take out any type of loan, please make sure you're reading the fine print and you understand what percentage you're paying to borrow the money, as well as any other fees that might be built into the structure of the loan. Because again, you don't want to be missing terms that can ultimately pull more from that principal by way of fees and other expenses. Moving into number 3, net worth versus income. This is a big one. I did a video on this as well. In its simplest form, income is the money that you make, right? Your salary, any investment gains you have, side hustles, and so on. Net worth is all of the assets to your name. So a car, cash, a house, retirement accounts, etc. The thing to know about this, and I want to make sure this is very clear, is that just because you have a high income does not mean you will also have a high net worth. It could and probably should, assuming you're saving a good percentage of that. But somebody who earns $60,000, $70,000 a year but saves very aggressively and starts early will probably have a higher net worth than somebody who earns well into six figures but spends everything they earn. Number 4, inflation. This is in the news a lot. There's a lot of political heads talking about this. Inflation is this idea that the value of the dollar over time goes down. So even if your savings is growing, let's say 1 or 2% each year, if inflation is 3%, that actually means that the dollars that you had earning 1 or 2% actually lost value relative to purchasing power across the economic situation. From a personal finance perspective, there's not a ton we can do about inflation because there's a lot of macro components that play into it. But it is worth noting that when you're saving and investing for long-term goals, keeping it in something like cash or a money market is likely less effective than something like a mutual fund or an ETF that should outpace inflation in the long haul. Moving into number 5, diversification. Big word here. Love talking about this topic. Diversification gets to this idea that you don't want to have all your eggs in one basket. For example, you wouldn't want to necessarily put all of your retirement or all of your net worth into a single stock or company. You want to diversify, right? You want to spread it out. By doing this, it ensures that if something doesn't go well for one of the investments that you have money in, you're protected because your money is spread across multiple investments. If you're someone who's invested in things like ETFs and mutual funds and target retirement funds, you're likely pretty diversified just inherently in those types of funds because they are invested across multiple companies. But as always, make sure you're doing your research in all your investments to make sure that your diversification is appropriate given your threshold for risk. Another idea that kind of goes hand in hand with diversification, index funds versus stock picking. So an index is a tracking system of a certain sector. So let's consider the S&P 500 index, which tracks 500 of America's biggest companies. It's kind of the best indicator as to how the US stock market is doing. If you buy into an S&P index fund, you get exposure or investment into all those 500 companies. Whereas if you pick one single stock or 2 or 3 or 4, you're only in those few. And again, if something goes south in one of those few, your net worth could take a big dive. Moving into number 7, tax brackets, specifically this notion that when you earn more, they take more. I did a separate video on this. The thing I want to make clear is that just because you make more money, it is true that the percentage that the government is taking on those dollars could be higher, but your tax rate within each tier of the bracket is the same across the board. It doesn't mean that your entire income is taxed at that rate. It just means the dollars past the bracket you were in are getting taxed at that higher rate. So the notion of if you earn more, they take more, there's a smidge of truth to that, but they'll never be taking everything. So it's pretty much always in your best interest to want to earn more money. On to number 8, another idea I love talking about, which is an opportunity cost. This isn't necessarily a specifically financial term. It's just this idea that whenever you spend a dollar in one place, you can't spend it in another place. Where it's important from a consumer perspective, I feel, is just having an awareness of if I go out to eat with my family and spend $100, I now can't use that $100 into a retirement account or towards groceries or another living expense or something like that. This is where budgeting is so essential so that you help to eliminate the feeling of, I don't know where I need my dollars to go, and you can avoid opportunity costs that could be damaging to your financial situation. I don't want to go into too great of a detail, but this is a fascinating concept because it also is very relevant as it relates to time, right? If you spend your time with your family, that's time you can't spend doing work. And when you're at work, that's time you can't spend with friends and so on and so on. So in my view, it's wise to have the opportunity cost mentality when it comes to things in life that are finite, i.e. money and time, so that you can allocate and plan for them in ways that work best for you and your family. Last concept, deductibles versus premium. These are insurance terms. Premiums are basically what you pay to have coverage, whether it's health insurance, auto, homeowners, renters, whatever type of insurance policies are relevant for you. I made a video about that as well. Feel free to check that out. Premiums are just the cost to have coverage. If you have to use your insurance, i.e. file a claim, that's where the deductible comes into play, and you have to pay whatever the deductible is before insurance starts to pay. The models of how and when insurance starts to pay and how long they'll pay differs from insurance to insurance. The general thing to know with this is the higher the premium, the lower the deductible, and vice versa. Happy to do a deeper dive on deductibles and premiums if y'all would like that, but I go into this in my insurance video in a little more depth, so check that out first if you would. So that's all I had there for today. Again, none of these concepts are necessarily overly complicated. You probably have a good amount of awareness, at least to some degree, with some of them, but it's good to raise the conscientiousness and just make sure that we eliminate any knowledge gaps that might have existed, and that's why I wanted to speak on this. Hopefully you found it helpful. As always, let me know in the comments anything you think I missed or another term you'd like me to break down or try to put in plain language. Always happy to do that. Otherwise, thanks for watching. See you in the next video.